Welcome to The Explainer. Today, we're going to get into something that honestly trips up so many businesses. When it comes to value-added tax, what actually counts as a supply? It sounds so simple, but the answer can get really complex really fast. So let's break it down and demystify the rules you need to know.
So, here's how we're going to tackle this. First, we'll lay down the law on the basic rule of what a taxable supply even is. Then, we'll get into the really interesting part. What happens when you give things away for free? From there, we'll look at a couple of special cases, like selling a part of your business. Then we'll pinpoint the exact moment the tax is due. And finally, we'll wrap it all up with the key takeaways you can actually use.
All right, let's start at the very beginning. Before we can jump into all the weird exceptions and special rules, we've got to nail down the absolute core of that. What does the law actually consider a taxable supply?
And to make this feel real, let's kick things off with a question I bet a lot of you can relate to. Does your business hand out free samples? Send gifts to clients? It just feels like a normal marketing cost, right? Well, this is exactly where the VAT rules can catch you by surprise. So keep that question in your head as we go. Okay, so here it is, the textbook definition. If you are a VAT-registered business and you provide goods or services in the kingdom as part of how you make money, that's a taxable supply. It's a really broad net, and it's designed that way on purpose to capture pretty much every transaction a business makes.
Okay, but this is where things get a little tricky, and honestly, a lot more interesting. What about all that stuff businesses do for free? The samples, the gifts, the on-the-house services. From a tax perspective, is free really free? Let's find out. And this is where we meet a really important term, nominal supply. Seriously, think of it like this. It's the tax authority's way of saying, hey, we know you gave that away for free, but for our purposes, it's kind of like you sold it. It's basically a tax on business generosity. But don't panic, there are some really important exceptions.
And the good news is, they get it. The rules recognize that businesses have to give stuff away to, get more business. So they've built in this kind of safe zone for your gifts and samples. But, and this is a big but, you have to play by two very specific rules.
So that first rule is all about the value per person. It doesn't matter if it's a product or a service. If what you're giving away is worth less than 200 Saudi riyals to any single person in a whole year, you're golden. It's not considered a taxable nominal supply.
Yep, that's the number you need to burn into your brain. 200 SAR, per person, per year. That's your magic number for all those little promotional gifts and samples. Stay under that, and you don't even have to think about VAT for that item.
But wait, there's a part 2 to this rule. A much bigger number you have to keep an eye on. The total value of everything you give away for free, every single gift, every sample, all of it added up, can't go over 50,000 Saudi riyals for the year. If you bust through that company-wide limit, the whole exception goes out the window, even if your individual gifts are tiny.
Now, outside of promotions, there are a few other specific cases where a free supply isn't taxed, like if goods are lost or stolen. Obviously, that's not a supply. But this last one, this is huge. If you never claimed the input VAT back when you first bought those goods, well, then you don't have to charge output VAT when you give them away. Makes sense, right? No tax in, no tax out.
All right, so that's the everyday stuff handled. Now let's shift gears and look at a couple of special situations. These don't happen often, but when they do, the financial stakes are way, way higher. We're talking about transferring part of your business and dealing with vouchers.
This is a massive deal, especially for anyone involved in mergers or acquisitions. The idea is if you sell off a whole chunk of your business, one that can actually run on its own, the sale itself can be treated as if it's completely outside the VAT system. We're not talking about an exemption here. It's more like, for tax purposes, the transaction never even happened. But you have to nail 3 very specific conditions.
So here's what you need to have in place. Condition number 1. The part you're selling has to be a real, functioning business on its own. 2. The person or company buying it has to be VAT registered or become registered. And 3, and this is a big one, you both have to put it in writing that you're treating it this way. You miss even one of these, and boom, that applies to the whole deal.
Okay, on to vouchers. This is a common one, right? The big question here is always, when does the tax clock start ticking? Is it when you sell the voucher or when the customer actually redeems it? Well, the answer is, it depends.
So, the basic rule is that a voucher is just a promise. It's like an IOU for a future purchase. So if you sell a 100 rial gift card for, you guessed it, 100 rials, nothing has really happened yet in the eyes of the taxman. The real taxable supply happens later, when that customer walks in and actually swaps that card for some real goods or services.
But there's a twist. What if you sell that 100 rial voucher for a little bit extra? Let's say you charge 105 rials for it. Well, in that moment, a taxable supply has happened. That extra 5 rials, that's seen as a fee for a service, and you've got to account for VAT on that fee right away.
Okay, so we figured out what a taxable supply is, but for your accountants, the next panic-inducing question is when? When exactly is the tax due? This is all about the date of supply, and you absolutely have to get this right.
Yeah, getting the date of supply wrong is not just a little paperwork oopsie. It can lead to penalties, cash flow nightmares. It's a big deal. The rules lay out these really specific trigger points that lock in the exact moment you owe the tax, and they're different depending on what you're selling.
So for most ongoing services, it's pretty straightforward. The tax is due on whichever of these comes first: the date on your invoice, the day payment is officially due, or the day you actually get the cash. But check this out. For government contracts, the tax is due the second that purchase order is issued. And if you're shutting down, you owe tax on whatever assets you're keeping on the day you officially deregister. You really have to know which one of these buckets you fall into.
Phew, okay, we have covered a ton of ground, and a lot of it was pretty technical. So let's just zoom out for a second and boil all of this down into the most important, need-to-know points for your business.
All right, think of this as your cheat sheet. Number 1, always start with the assumption that everything you do is taxable, unless you can prove it fits a specific exception. 2, track your freebies. Keep those 250,000 rial limits front and center. 3, remember that a nominal supply is just a fancy term for a freebie that's still taxable. 4, if you're thinking of selling a part of your business, memorize those 3 conditions for it to be non-taxable. And finally, 5, make sure your finance team knows the exact tax due date for every kind of transaction you make. No guesswork allowed.
And that really brings us to the final, and maybe the most important question of all. Knowing all these rules is great, but the real test is putting them into practice, right? So I want you to go back and take a really honest look at your own systems, your accounting software, your processes. Are they actually set up to handle all these little details? Because when it comes to VAT, good tracking isn't just a nice to have, it is absolutely everything.